Good afternoon, folks. Welcome to Liberty Call for Thursday, June 2nd, 2022. Hope everybody's having a great day out there. It's a beautiful day here in Colorado. Sunny skies, it's 63 degrees, and the woodland creatures have been out and about, which makes all of us happy out here in the countryside. So, again, hope everybody's having a great day. If it's your first time watching, give me one of these big old thumbs up, a like, a share, subscribe. I would greatly appreciate it. And I'm sure there's other folks out there who would like a no nonsense take on what's going on in the world. So, all right. Well, pretty good day in the markets. Yesterday was pretty bad. Today's pretty good. I think we're probably going to have a lot of this for quite a while. So, buckle up, buckaroos. Let's go ahead and take a peek at today's markets. The Dow Jones was up 1.33%, closed at 33,248. S&P was up 1.85, closed at 4177. Nasdaq up 2.69%. Techs obviously had a big comeback today. Currently sitting at 12,316. Small caps are up 1.84%. The VIX retraced 3.78% today. It's currently sitting at 2472. The other exchanges here in the Americas, Canada was up 1.54, Brazil was up 0.99, Mexico down 1.01. Heading over to Europe, Germany was up 1.01, the UK down 0.98, France up 1.27, the Euro stock's up 0.95. Netherlands were up 0.32. Spain basically ended flat at down 0.04. Italy up 0.59, Switzerland up 0.49, Portugal was down 0.67. Down a little further, Belgium finished flat at up 0.09, Austria up 0.89, Sweden up 1.69, pretty good day there. Denmark up 0.26. Both of the Russian exchanges were down today. The MOEX was down 1.45, the RTSI down 2.14. All right, let's move over to Asia. Japan was down 0.16, Australia down 0.8, New Zealand down 0.78. Heading over to China, the Shanghai was down, or I'm sorry, up 0.42. The SESE component was up 0.67. The China A50 finished down 0.34. DJ Shanghai up 0.38, and the Hang Seng was down 1%. And the Taiwan weighted came in down 0.73. So kind of mixed in the Chinese markets, and Asia looked mostly, again, kind of mixed, but mostly down. Mostly greens across Europe, and a lot of greens here in the United States, which I guess is pretty good. Again, looks like we're kind of in what they call a secular bear market, which it's kind of like the seasons. You don't necessarily judge it on just what's been trading, day to day or week to week, but you're looking at the overall trend. Going back to January, we've been in this down slope for quite a while. There's a bug flying around, and so we'll see what happens. If we break the longer term trend, then we'll ride that upswing for the foreseeable future. But again, until the market, or until the momentum changes, then we'll just stand pat and see what happens. All right, let's take a look and see today's market recap. S&P 500 climbs as tech jumps despite Microsoft's warning. S&P 500 rose Thursday, recovering from early day losses after Microsoft warned on performance, and the Federal Reserve signaled that it isn't considering pausing its rate hikes later this year. Boy, that's making a lot of people angry who like those interest rates at or near zero. Microsoft slashed its losses despite cutting its outlook for fourth quarter profit and revenue, as a strong dollar is expected to weigh on foreign revenue. Its shares were, it just says 0.5. So were they up or were they down? They didn't say. The tech giant now expects earnings in a range of $2.24 and $2.32 per share, down from a prior forecast of 2.28 to 2.35. Revenue for the quarter was lowered to between 54.94 billion and 52.74 billion, down from a prior range of 52.4 billion to 53.2 billion. Other tech stocks recovered from an early day slump led by Meta Platforms as investors bought the dip that followed an announcement on Wednesday from the social media company that Sheryl Sandberg was stepping down as chief operating officer later this year. I'm sure there were a lot of tears shed over that. Chip stocks underpinned by gains in Nvidia and AMD ahead of the latter's investor day on June 9th. Tech was also supported by a breather in Treasury yields, even as the Federal Reserve Vice President Lael Brainerd downplayed expectations that the Fed could pause rate hikes in September. Quote, right now it is very hard to see the case for a pause in September, Brainerd said. Quote, we still have a lot to do to bring inflation down to our 2% target, end quote. The remarks came on the heels of the data showing fewer than expected private job gains for May. Private payrolls grew by 128,000 in May, a decline from 202,000 in April, according to a report released Thursday by ADP and Moody's Analytics. That was well below the economist forecast of 300,000, I'd say. The private payrolls report, which at times served as a precursor to the non-farm payrolls for May, expected to be released on Friday, isn't a reliable indicator. Quote, on the face of it, therefore, the report appears to support our below consensus forecast for tomorrow's official number, but ADP is not a reliable indicator of the official payroll numbers, Pantheon Macroeconomics said. Energy stocks were lower even as oil prices rose more than 1%, and after OPEC and its allies agreed to increase output in July and August. Well, they've been saying that for a while and haven't really seen much of a change. Valero Energy, APA, Diamondback Energy were among the biggest gainers in the energy sector. In other news, GameStop rose nearly 12% after reporting a wider than expected loss. Why would it rise 12% after a wider than expected loss? It doesn't make sense. That, quote, was almost entirely driven by higher SG&A expenses as management continued to aggressively hire professionals across blockchain gaming, e-commerce, and technology and operations, Wedbush said in the note. All right, so that's the daily recap. On to some economic news. U.S. labor market stays strong. Unemployment rolls smallest since 1969. The number of Americans filing new claims for unemployment benefits unexpectedly fell last week as demand for labor remained strong, helping to underpin the economy amid rising interest rates and tightening financial conditions. The weekly unemployment claims report from the Labor Department on Thursday, the most timely data on the economy's health, also showed state jobless benefit rolls declining to their lowest levels since 1969 in the second half of May. The Federal Reserve's aggressive monetary policy stance as it fights high inflation has fanned fears of recession, while other data on Thursday showed the increase in private payrolls in May was the smallest in 2 years. That was also partly because of worker shortages. The U.S. Central Bank is trying to cool labor demand without pushing the jobless rate too high. Quote, job gains across the country are slowing, but few workers are actually losing their jobs, end quote, said Christopher Rupke, chief economist at Forward Bonds in New York. Quote, this isn't a soft landing or a hard landing for the economy yet. No signs of company layoffs means the labor market isn't loosening up as much as the Fed officials were hoping, end quote. Initial claims for state unemployment benefits fell 11,000 to a seasonally adjusted 200,000 for the week ending May 28th. Economists polled by Reuters had forecast 210,000 applications for the latest week. The second straight weekly decline unwound recent increases, which had lifted claims to their highest level since January. There were big declines in claims in Pennsylvania, Kentucky, Georgia, and Florida, which offset a jump in California, as well as notable rises in Mississippi and New York. The number of people receiving benefits after an initial week of aid fell 34,000 to 1.309 million during the week that ended May 21st. That was the lowest level for so-called continuing claims since December of 1969. Companies are scrambling for workers, though the Fed's Beige Book on Wednesday showed, quote, one district explicitly reported that the pace of job growth had slowed, end quote, and that, quote, some firms in the most of the coastal districts noted hiring freezes and other signs that market tightness had begun to ease, end quote. But the government also reported that there were 11.4 million job openings at the end of April, while the job workers gap fell from 3.6% of the labor force in March. It remained very high at 3.3% in April. Economists say claims would need to rise above 300,000 to cool the hot jobs market. Quote, a low level of layoffs as well as elevated job openings are signaling that demand for labor remains strong, a trend that is likely to persist in the very near term, said Rubila Faruqi, chief U.S. economist at High Frequency Economics in New York. Let's see here. Labor market strength was reinforced by a second report on Thursday from global outplacement firm Challenger Gray and Christmas on Thursday showing layoffs announced by U.S. based companies fell 14.7% to 20,712 in May. So far this year, employers have announced 100,694 job cuts, down 48% from the same period in 2021. That's the lowest recorded January through May total since Challenger began tracking monthly job cut announcements in 1993. That overshadowed the ADP National Employment Report, which showed private payrolls rose by 128,000 jobs last month after increasing 202,000 in April. That was the smallest gain since April of 2020, when the economy was reeling from COVID-19 shutdowns and lost a record 20.493 million jobs that month. Economists had forecast private payroll increasing by 300,000 jobs. The ADP report, jointly developed but with Moody's Analytics, has a poor record predicting the private payroll counts in the department's Bureau of Labor Statistics employment report because of methodology differences. Okay, if you say so. Quote, the ADP data suggests that job growth is slowing, which at a very high level is broadly in line with our expectations for the labor market, said Daniel Silver, an economist at JP Morgan. Quote, but we know that the ADP report is not always a reliable predictor of the BLS data, so it's not clear if the BLS data will be weak as the ADP reports may print. Excuse me. The government's closely watched employment report on Friday is expected to show strong job growth continued in May. According to a Reuters survey of economists, non-farm payrolls probably increased by 325,000 jobs last month. The economy created 428,000 jobs in April, marking 12 straight months of employment gains in excess of 400,000. So we'll see. We'll see. I think things are going to slow down faster than we think. But again, what do I know? All right. On the oil front, oil rises after U.S. crude drawdowns and supply tightness. Oil prices edged higher on Thursday after U.S. crude inventories fell more than expected amid high demand for fuel, and OPEC Plus agreed to boost crude output to compensate for a drop in Russian production. U.S. crude oil stockpiles fell last week by 5.1 million barrels to 414.7 million barrels, compared with analyst expectations in a Reuters poll for a 1.3 million barrel drop. So they were off by 4 million? Pretty big. Prices, however, were also supported by the European Union's sixth package of sanctions against Russia, approved on Thursday, which will include an immediate ban on new insurance contracts for ships carrying Russian oil and a 6-month phase out of existing contracts. The benchmarks have mostly marched higher as several weeks of Russian exports have been squeezed by U.S. and EU sanctions against Moscow over its February 24th invasion of Ukraine, an action Moscow calls a special military operation. Is that what we called it when we invaded Iraq and Afghanistan? I don't remember. The market has also seen support from China's gradual emergence from strict COVID-19 lockdowns. Oil prices fell earlier on Thursday ahead of the OPEC Plus meeting on expectations Saudi Arabia and other OPEC members could boost oil output to offset the drop in Russian production. The Organization of Petroleum Exporting Countries and allies, including Russia, known as OPEC Plus, agreed to raise output by 648,000 barrels per day in July and 648,000 barrels per day in August, a source told Reuters. While OPEC Plus agreed to increase their production quota by a bit more than the market expected, in reality, it does very little to add additional supplies, as OPEC Plus was already falling short of its existing quotas by over 2 million barrels per day, said Andrew Lippo, president of Lippo Oil Associates in Houston. Russian production has fallen by around 1 million barrels per day following sanctions. One OPEC Plus source familiar with the Russian position said Moscow could agree with other producers raising production to compensate for its lower output, but not necessarily making up all of the shortfall. The Kremlin says it can reroute oil exports to minimize losses from EU sanctions, but analysts remain skeptical. Quote, the extent to which this will provide achievable is questionable. However, Russian oil production is therefore likely to fall again in the coming months, end quote, said Commerce Bank analyst Karsten Fritsch, who also questioned OPEC Plus's ability to add considerably more oil to the markets. All right, so it doesn't look like oil is going anywhere anytime soon. So, up next, what the White House wants to do with oil companies. White House weighing oil profit tax to fund consumer rebate, officials say. This sounds like price controls, people. That never works out well. The White House is considering proposals that would tax oil and gas windfall profits in order to provide a benefit to consumers struggling with higher energy prices, a U.S. official said on Thursday. Bharat Ramamurthy, the deputy director of President Joe Biden's National Economic Council, said the administration had been examining U.S. Senate and House of Representative proposals that could hike taxes on energy producers in order to provide a subsidy to consumers. We are very much, quote, we are very much open to any proposal that would provide relief to consumers at the pump, end quote, he said during a panel sponsored by the Roosevelt Institute, a think tank. Quote, there are a variety of interesting proposals and design choices on a windfall profits tax. We looked carefully at each of them and are engaging in conversations with Congress about design, end quote. High energy prices have pushed large oil producers to record profits this year. ExxonMobil Corp, the largest U.S. oil producer, doubled its first quarter profit to $5.448 billion and said it would triple its expected stock buybacks through 2023 to $30 billion. The Biden administration has criticized producers for not investing in further production and companies generally for not passing on more of their earnings to consumers. Well, Joe, you stopped a lot of the exploratory production, and I think a lot of these oil companies really don't want to put too much investment into the sector while you're in office. I think that probably has more to do with it. Britain last week announced a 25% windfall tax on oil and gas producers' profits alongside a 15 billion pound package of support for households struggling to meet soaring energy bills. One proposal backed by 15 Democrat-aligned senators and several members in the House would levy a new tax on large oil companies quarterly for crude produced domestically or imported. The revenue would be paid to consumers under a certain income in the form of a tax rebate that would amount to a few $100s per year. Woo, a few $100. But the bill faces uncertain prospects in Congress. Yeah, it's probably going nowhere. The discussions come as Biden has come under intense pressure to ease price pressures, especially for gasoline ahead of November's midterm elections and his Democratic Party's control of Congress on the line. Yeah, I think that's over. Quote, one thing you want to be aware of when you are looking at these types of proposals is how it's going to affect supply as well, said Ramamurthy. Quote, I don't think it's an insurmountable hurdle, but it's an important question at a time when there's clearly a supply issue, end quote. The U.S. economy had its strongest growth in nearly 4 decades in 2021 after the government poured trillions of dollars in COVID-19 relief into the economy, and the Fed kept borrowing costs near zero. Well, let me stop there. I don't know if the strongest growth is really the best thing to be talking about when you flooded the economy with all that money. To me, it's kind of a false bull market because you just created money out of thin air, poured it into the economy, and said, "Oh my God, look, everything's going great." Well, what was the consequence of that? It was the inflation we're feeling right now. So, yeah, it helped out, made things look good, and it, put lipstick on that pig 2 years ago. But now we're having to, live with those consequences, and what's that going to do to us long term? The rescue efforts helped to drive unemployment down to 3.6% from its pandemic era high of 15%, but also revved up consumer spending that has contributed, along with the war in Ukraine, to higher prices. U.S. consumer price growth slowed in April as gasoline prices eased off record highs, suggesting that inflation may have peaked. Yeah, I don't think so. Consumer prices were up 8.3% in April from a prior year, according to the Labor Department. So, yeah, I mean, it sounds great on paper. Yeah, we'll give some money back to the people, and they'll think we're the greatest thing ever. But the problem is that you're stealing from the oil companies, and that's taxation is theft. So you're stealing from the oil companies, and then you're giving it back to the consumer, all the while taking a nice little commission for yourself on all the little everywhere it goes through the government because you got to pay all those worthless government employee salaries. And I'm sure they're probably going to hire some more people. You got to have a board that has to decide, who to tax and how to tax it, and how to keep track of all those things. So yeah, I don't have much confidence in what they're doing. All right, moving over to the Fed policymakers. September rate hike, a question of how big, not if. Yeah, again, you've heard me talk a lot about in a lot of articles how it seems like those writing the articles and those that they're interviewing are not really in favor of raising interest rates. And even though it's the good medicine we have to take to get through this, they'd rather take the bad tasting, take the good tasting medicine, which unfortunately leads us to bigger and bigger problems. All right. The Federal Reserve is likely to continue tightening monetary policy beyond the half percentage point interest rate hikes expected at each of its next two meetings. Two policymakers signaled on Thursday, with the only question of being how much. Quote, market pricing for 50 basis points potentially in June and July from the data we have in hand today seems like a reasonable path, Fed Vice Chair Lael Brainerd told CNBC. That's her right there. She looks very healthy. Let's see. By September, she said, quote, if we don't see the kind of deceleration in monthly inflation prints, if we don't see some of the really hot demand starting to cool a little bit, then it might be appropriate to have another meeting where we proceed at the same pace. But even if price pressures are starting to abate, the Fed will likely raise rates just by a smaller amount, she signaled. Quote, right now, it's very hard to see the case for a pause, end quote. She told CNBC, noting there is, quote, a lot of work to do, end quote, to get inflation running at a 40-year high down to the Fed's 2% target. The U.S. Central Bank has raised interest rates by 3/4 of a percentage point this year, and most Fed policymakers back raising interest rates another half a percentage point at each of the next two meetings. Atlanta Fed President Raphael Bostic has suggested that by September, the Fed ought to pause to assess the state of the economy before tightening policy further. Brainerd's remarks suggested that that's not the view of the core Fed leadership. Traders of interest rate futures are currently pricing in better than even odds of a year-end Fed policy rate in the range of 2.75 to 3%, a full 2 percentage points higher than it is today. Speaking to the Philadelphia Council of Business Economics, Cleveland Fed President Loretta Meester, we talked about her a while back, called for Fed fortitude in the face of what could be volatile markets, slowing growth, and even a rise in unemployment as the central bank ratchets up rates higher to fight unacceptably high inflation. To Meester, the Fed needs to get rates to 2.5% as quickly as practical, she said Thursday, and then likely even higher. After 2.5-point rate hikes in June and July, the Fed's policy rate will be in the range of 1.75 to 2%. Quote, I will be reluctant to declare victory too soon, end quote, she said of high inflation. Yeah, it's a bit of a tug of war between the people who want low interest rates and those who want high interest rates, and we the consumer are kind of stuck in the middle right now. All righty, some good news if you're into some home improvements. Lumber is the cheapest in 7 months as housing market softens. The days of pricey lumber might finally be over. Lumber futures are toppling to levels not seen since November amid fears of a softening housing market and economic recession. Futures fell as low as $604.50 per 1,000 board feet in Chicago on Wednesday, extending a slump of about 46% this year. The commodities collapse is a stark reversal from all-time highs set in 2021 during a pandemic-fueled home building boom. Quote, labor markets are probing for a floor, end quote, said Kevin Mason, managing director of ERA Forest Products Research, noting concerns about collapsing home sales and rising interest rates are pushing prices lower. Recent comments by JP Morgan Chase & Co.'s chief executive officer, Jamie Dimon, aren't helping, Mason said. Earlier on Wednesday, he warned investors to prepare for an economic hurricane, given challenges including tightening monetary policy and Russia's invasions of Ukraine. You gotta wedge that Russia invasion in. Lumber prices may fall into the range of $400 per 1,000 board feet in the next 2 months before producers curb production to remove excess supply, Mason said. So, again, if you got some, you want to go out and build a fence or do some minor construction around your house, now is probably the time to start looking at, your plans on that and see what that'll cost you in the long run. So, at this point, your lumber costs are down 46% from the high, so which is good. I need to go back and look and see what they were 2 years ago before all this madness got started. So, all right. Well, that's everything I had for today. Hope everybody has a fantastic night. No Astros baseball today. I'm a little sad about that, but hey, it is what it is. They deserve a day off. They've won four straight. They got a 5.5 game lead on the Angels, which, well, maybe 6 games. I haven't seen the Angels Yankee score. I know they were playing a day game because yesterday's game got, I think, rained out. But all right. Well, that's everything, like I said, that I had. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I hope everyone has a fantastic night. Talk to you tomorrow. Bye.